How much can I borrow on a mortgage? If you're looking to make a purchase or indeed remortgage your current property to release some equity, it's a very pertinent question and one that you'll want to know the answer to. I obviously can't give you a direct answer without knowing your personal situation, but in this video we're going to look to answer the top 10 questions that clients have that relate to mortgage borrowing to hopefully give you an indication of how that decision is made, to give you a bit of a steer. How much can I borrow on a mortgage based on my income? So if you're looking for a very crude calculation, lenders as a maximum will quite often offer somewhere between 4.5 and 5.5 times your income as a borrowing amount. However, the multiple that's applied will depend on a number of things, such as your level of income, level of deposit, term of the mortgage, all these kinds of things. So there's no clear-cut one answer fits all, but that is the kind of the range that you can expect the maximum to fall within. How does the affordability assessment determine how much I can borrow on a mortgage? Lenders have two restrictions, if you like, when they're looking at max lending. One is the maximum multiple of your income that they'll apply, and the second is the affordability assessment. The affordability assessment looks at your net income from all sources and then looks at any kind of committed expenditure. So that might be repayments on credit commitments, any childcare, and they'll also factor in data from ONS for general cost of living. So how much does food cost, how much does council tax cost in your area, all those kinds of things. And they'll look at what you have coming in, what you have going out, and therefore what you have left over each month to pay towards the mortgage. And from there, they can work out backwards kind of how much they think is affordable for you to borrow, given that you can repay that much per month. How does my credit score affect how much I can borrow? Lenders generally have a kind of yes-no policy when it comes to credit. Either you reach the score required and they can lend to you, or you fail to reach the score required and they won't lend to you. It's fairly black and white. However, there are some instances where lenders might say, okay, your credit score is not sufficient for you to borrow at 90%, but we are happy for you to borrow at, say, 85%. So in this way, a credit score can determine how much you can borrow based on the minimum level of deposit the lender requires. The reason that they might ask for a larger deposit if your credit score is not so strong is to reduce the risk from their side. How does my level of deposit impact how much I can borrow on a mortgage? Well, generally speaking, the larger the deposit you have, the larger the multiple of income the lender is going to apply when they're working out maximum borrowing. It's all very lender specific. They'll all have different thresholds and different multiples that apply at those thresholds, but as a general rule of thumb, bigger deposit means higher multiple of income. Can I borrow more if I have someone else on the mortgage? Potentially yes, and there's two ways you can do that. You could have them as a joint owner of the property, so you both own the property, you both have responsibility for the mortgage. The second way of doing it is what's called joint borrower sole proprietor, whereby you would both be joint borrowers on the mortgage, both liable for the debt, but you would be the sole proprietor, the sole owner of the property. Whether or not you can borrow more with someone else on the mortgage depends on their situation. So the lender will look at affordability across both of you. So that'll mean things like the income that's being generated, the credit commitments. So if that person already owns a property that has a mortgage on it, that will go against them. And things like your age. So a lot of people look to put parents on the mortgage. Generally speaking, if you're older, the maximum term that you can have the mortgage to is going to be reduced because you're closer to your retirement age. And in some cases, I've actually seen where putting a parent on reduces the amount you can borrow, because even though we're adding an income, we're squashing the term down so much that the affordability gets so tight, it actually reduces what you can borrow versus what you can do individually. How does self-employed income work for borrowing on a mortgage? Well, this all depends on how you're set up. It might be a sole trader, a partner, or a director of your own limited company. But as a very general rule of thumb, lenders will look at an average of the last 2 years' earnings. And if it's increased, they'll use the average. If it's decreased, they'll use the lower figure. However, there are some exceptions to this. Some lenders will use the most recent year's figure only, even if it is increased. So it's all very much down to the lender. Once they've actually determined the income figure that they're going to use for the assessment, it's then exactly the same as if you were an employed applicant. They'll look at that income, apply the maximum multiple of income, and they'll use that income for the affordability assessment when they're looking at income versus outgoings and determining how much you can borrow via that method. How does bonus, overtime, and commission income affect how much you can borrow? Well, the total income that lenders use for the income multiples and affordability assessment will include things like bonus, overtime, and commission. However, with any variable elements of pay, they are going to be treated differently by different lenders, and the percentage of that additional income that is used for their affordability and loan to income assessments will vary. Some will use 100% of it, Some will only use 50%, some will use 60%, some will use an average of the last 3 months, some will use an average of the last 6 months, some will want a P60. So it all depends on the lender as to how that income is treated. But generally speaking, yes, we can use it towards affordability to increase the amount that you can borrow. Can I borrow more on a mortgage if I have little or no existing debt? So one of the restrictions lenders apply when they're working out how much you can borrow is their affordability assessment. Income versus outgoings to determine what you have left over each month to pay the mortgage. From there, they work backwards to work out a maximum loan amount. If you have little or no credit commitments, that works in your favour because your committed outgoings are going to be smaller. Therefore, the amount left over you have each month to make a mortgage payment is going to be higher. A lender will look at that and say, okay, we think they can afford to borrow a bit more. How does the mortgage term affect how much I can borrow? Generally speaking, the longer you take the mortgage term, the more you can borrow. This is based on the lender's affordability assessment, where they look at income versus outgoings and how much you have left over each month to make the mortgage payments. If you're extending the mortgage term, you're going to be reducing the monthly payments because you're paying that back over a longer period. If you've got lower monthly payments, they'll deem it to be more affordable and therefore you can borrow more. Can I borrow more if I choose an interest-only mortgage? Potentially, it depends on the lender. Different lenders use different methods of calculating affordability. Some will assume the mortgage payment based on full repayment, even if you're taking an interest-only mortgage. Others, on the other hand, will factor in the lower monthly payment as a result of putting the mortgage on interest-only, therefore improving affordability and potentially increasing the amount you can borrow. For the lenders that do use the repayment model, where they assume the mortgage is going to be on a repayment basis regardless, you can quite often borrow less on an interest-only mortgage. The reason being, a lot of lenders apply a reduced term to interest-only mortgages. So if you're applying to a lender that applies the affordability model that as if you're on full repayment and they're bringing the mortgage term down by say 5 years, the amount you're going to be able to borrow is actually reduced just by choosing an interest-only mortgage. Slightly complicated, but all essentially depends on the lender and how they assess affordability. So those are our top 10 questions people generally ask us when looking at affordability and how much they can borrow. As I said at the start, I'm not going to be able to give you an exact number on what you can borrow, but hopefully those questions have given you a bit of a steer as to how it's calculated. So it gives you a bit more information to work from. If you found the video useful, then please do check out others on the channel. Plenty of good information in there for you to explore.